Hey, what's up everybody? Welcome to the 40 Finance channel. Checking in here after the Easter weekend to look at some of the biggest headlines in the stock market today. Hopefully you guys got some rest and family time during the stock market weekend. During the Easter weekend, hopefully you had decent weather. It was kind of hit or miss here in Cincinnati. Didn't have as much rain, but it was, man, it's cold in here for the Midwest. We can't seem to break out of whatever cold pattern we're in. So it's like our average temperature, I think, is like 65, 60 degrees, something like that this time of year. Today, on Monday, we actually had snowflakes in the air, and I think it's coming in about 40, 45 degrees. So it's wild. It's a wild spring, and be interested to hear, if everybody else is in the same boat. But we're talking stock market headlines, and so let's jump into that. And I pulled some of my favorite headlines out here from Seeking Alpha that always does a good job on their news. And if you're interested in learning more about Seeking Alpha, my affiliate link is in the description. Check it out and get yourself a nice discount. But I thought this one was interesting, right? Particularly compared to the sentiment that we hear. Kevin Hawthorne, good to see you. Happy Easter to you. Goldman Sachs sees 1 in 3 chance of a recession. So if you spend any time on YouTube, you would probably be shocked at this, because I feel like, the popular opinion is that we can't avoid a recession. It's inevitable. So let's take a look at this. This is from their economics team. 35% chance of a recession over the next 2 years, with the labor market a particular problem for the Reserve. Large gap between jobs and workers, keeping wage growth elevated, has historically only declined during periods of economic contraction. La-di-da, predictions for a recession have been growing as the Fed tries to negotiate soft landing. We already know that. Deutsche Bank was the first big Wall Street bank to forecast a recession, saying so in the first week of April. And the recession in late 2023 is now their base case. So on one hand, you have a known bank saying 1 in 3 chance, and apparently Deutsche Bank says that's their base case for late 2023. So what's one of the popular quotes here? Taking at face value, these historical patterns suggest the Fed faces a hard path to a soft landing, but other strategists are more cautious. Wells Fargo, Chris Harvey said last week that daily calls for a recession from anyone with a megaphone. We do not expect one over the next 12 months. So I sort of agree with Chris Harvey here in the sense that I certainly don't see a recession in 2022. And I'm not smart enough to predict out much farther than that. I think things will slowly get back to normal. I think summer has the potential to be a big boon for the supply chain, etc. And I think that it's a very noisy analytics environment right now with, unfortunately, the bad news sells clicks, right? It sells a lot of things. Bad news gets attention, it drives clicks, and it drives sort of a sheep herd mentality. I think that there's a lot more to it. Credit Suisse says it is not underweight in equities. Equities are fair valued, not overvalued, with equities being an inflation hedge compared to bonds. Monetary conditions are very loose. We only tend to get recessions 9 months after a 3-month money inverts relative to the 10-year. So they're apparently tracking the 10-year interest rate and calling for that. I think that that's another common line that you hear from people is when there's crossovers in the interest rates, the short term versus long term. There's a lot of articles out there that say that this is the sign. We've never not had a recession when this happens. Every situation is different, And I would, I kind of go back towards how many times have we had a recession with unemployment so low? It is really the founding principle, not to mention, from my standpoint, the concept of being so behind on warehouse inventories and, the gas costs, which is of chief concern, but I also see that world can be fixed. We'll see if it is fixed, but it can be fixed, particularly here in the United States. All right, so that's headline number one, 35% chance of a recession. Headline number two, and this is starting to get a little concerning on the chip side, for me anyway, as someone who follows the chip sector and really enjoys reading about it. But Qualcomm Skyworks Solutions dip as Mizuho cuts price targets on chip stocks. So let's dig down deep in here. Mizuho cut the price target on several semiconductor stocks, citing multiple headwinds, including weak 5G demand. So we've been talking about 5G for, 2-3 years now, and how it's supposed to change the world. And it hasn't changed the world yet. I do think it'll be the standard, going forward, but it's amazing how long it's taken the consumer to really get excited about it. You have that early adoption phase, which I think we're already through. And then if we do have weak 5G demand, which really translates into weak demand for wanting to upgrade your phone, right? So I actually did do an upgrade on my phone to get 5G, but it was a very comparable model. There wasn't like I upgraded to get the 59 cameras and whatever. It was just so that I could get the 5G service. And, it seems like maybe I'm in the minority in that stretch. So this analyst lowered the price target on Qualcomm to 185 from 210. Corvu was lowered to 135 from 155. Skyworks lowered to 175 from 210. Skyworks, of course, that would be the highest connection to cell phone sales. Synaptics was cut to 250 from 290. As the analyst noted, 5G handsets for 2022 should be roughly 660 million units, compared to the previous outlook of 700 to 750 million. So he's backing down about 100 million on the amount of cell phone units. That's probably not a good sign for Apple, but I've talked about Apple in the past. In fact, I just did, I think, a video maybe last week or the week before. But really what's going on with Apple right now is that SE unit doesn't appear to be, catching fire very well. I think what will happen for Apple is it'll be a non-event, and people still seem to love the flagship iPhone. So maybe we'll see the money go in there. The SE, even if it doesn't end up selling well, I think that might just be a model problem, the attractiveness of the model. All right, overall, we believe investor sentiment is very negative, especially with Shanghai, the biggest manufacturing hub in China for handsets, PCs, autos, is still in lockdown with logistical constraints. 2018 levels, in a note to clients, he added, since valuations had dropped to 2018 levels, it's possible investors may move back into semiconductor stocks. And I think that's where you have to add, you have to think about this over the long term with chip stocks. So this negative sentiment, which I've noticed across chip stocks lately, in just a cooling demand for the PC market. Now we're digging into the cell phones. Logistics has always been a problem. Now China's locking down. There are a lot of headwinds. But I think that if you're an investor in chip stocks, which mostly for me pertains to the QQQ, I would say long term, it may not be a boom cycle this year or next year, but long term, I just don't see how these companies don't perform at a meaningful level from just the inundation of where chips are used. So We can look at it on two different levels. This can be certainly negative in the short term, but from a buying opportunity, ideally you're probably buying it when demand is softening. Maybe you don't need to run out here and buy right now, but I would imagine it's going to take till the second half of the year for some of these negatives to go away. 21, what's going on? You say Goldman Sachs sounds pretty positive, or they're trying to hide something. Stagflation is not going to be great for stocks, and you're also heavily invested in chip stocks. So it'll be interesting if you're going to try to average down or just, wait it out, wait for them to bounce. But I think this is the next headline. Yeah, AMD is under $100. All right, so here's, I think, some of this contradiction that I wanted to show. This is our next headline. Intel AMD devices may have PC weakness already baked in, Bank of America says. So we know that PC weakness has been out there for a while, mostly because getting out of work from home. We're also had such a boom cycle in gaming that a lot of people are thinking that the PC market could be a little bit weak. But Bank of America said any concerns about the weak PC market could already be baked into their stocks. In a note previewing the chip sector, they pointed out that weakness in the PC is now well known, but any more concerns from Europe due to the war as well as COVID could push PC demand further in the second quarter. However, we believe the mix towards enterprise and away from Chromebooks would provide a tailwind. PC x Chromebooks were actually up 3% year over year in Q1. The analyst added that Intel is more exposed than AMD to a slowing PC market, but Pat Gelsinger-led company guided conservatively when it last reported. Conversely, AMD has a number of other positive levers, including Xilinx addition, console demand, and strength in cloud computing. I would say, in my opinion, from an eyeball perspective, AMD, if you can build that position under $100 for the long term, I just don't think that there's a lot of risk there for some of the reasons that were said in that article. And Intel, I think, is a great long-term play as well. The problem with Intel that most people won't want to buy in is I just think you're 12 months away from the momentum really to get going again in Intel, just because they have so much building to do. And frankly, the earnings reports and the revenue projections look essentially flat for this year. We'll see if that changes as the year goes on. But between the two for short-term returns, I think AMD is probably the better buy now and over the next few years. But Intel could be a long-term investment that pays off significantly if they execute on their plans. All right, Derek's here. He's buying Intel. He's been buying Intel for a while, so he'd probably disagree with me. Who else? Michael T. I've been DCA into Disney for a while and just bought 25 for 125. I like Disney. I like Disney. They're getting killed on the politically correct content, but I think that it's a big summer in travel. Vicky's here. Good to see you. And here's my third headline. So Netflix, so we got some earnings to look at. This isn't such an awesome headline, but I think that this exemplifies what we're going to see out of a lot of stocks. Netflix earnings likely to be overshadowed by the all-important Q2 guidance. And if you're listening to this show, I would just keep this in mind. Insert almost any company you want to right here. So, we get excited sometimes when we see companies hit their earnings numbers. Let's see if I can grab a quote here. But what happens is, it's not uncommon to see a stock hit the top line and the bottom line and then come out and say something that spooks everybody. Like, we don't know what's going to happen in the summer, or we're not providing guidance because of COVID, which is what we went through quite a bit over the last couple of years. And this analyst, Nat Schindler, who rates Netflix a buy at 605, noted that the second quarter guidance will be driven by the return of Stranger Things, as well as lingering impact from Bridgerton. We are, however, somewhat concerned that the street is expecting too much from these in seasonally weak second quarter, with street estimates of 2.6 million being higher than the first quarter guidance, something that hasn't ever happened in Netflix history. So the point there is, to translate, Wall Street is expecting more subscribers to come in Q2 than Q1. This guy is saying that's never happened in history. And probably the worst part for Netflix, and there's other ones like them that are in this boat, of the the memberships and the signups, subscriber signups, that they just cannot get their eyes away from. Right? It has nothing to do with how much money Netflix is making incrementally, which, if you look at their EPS forecasts, it's projected to be a profit machine. There's also this common knock on Netflix that they write out their expenses over the long term, particularly when it comes to show production. Off the top of my head, if they produced a show, let's just say they made a movie, right? They write those costs down over a 10-year stretch. There's a lot of people that don't like that on the internet. Myself, I like Netflix, so I just want to say, keep this in mind, that I'm sort of bullish on them. But a piece of content in today's world and the way it resides on Netflix service, I think the 10-year write-off time frame is absolutely fine. Because if they made a blockbuster streaming video, right? So a little bit different than a blockbuster theater video, that lives on their platform for at least 10 years. And when you think about all the times that you've went back and watched movies that you've liked, we're in 2022 now. I mean, when's the last time you watched a movie from between 2000 and call it 2012? Like, I've watched a dozen of them. Probably this year at least. So, that's a separate video, but Netflix gets squashed hard on subscription additions, and I wouldn't be surprised if this headline is relatively accurate, that they're saying, they may get dinged again if 2.6 million is the number, which is higher than first quarter guidance. So if they get dinged again, I think you have to consider it. I mean, when you're at 336, you can probably barely see that, 336 today. We know it's been run down. This past 12 months of EPS has been a little up and down because of expenses, but the future looks good. I think Netflix is a relatively safe investment, and it's a buy low candidate. Lots of people have different opinions, though, and that's okay. I'm just sharing mine. All right, got two more. I got two more headlines. This one here, Etsy, which stock I used to own, and I have been watching it and still mildly interested at 109. But Etsy sellers are pissed. That's not the headline. Etsy sellers consider forming a union after higher transaction fees are fired off. So somewhere down here, the dissatisfaction with sellers ramped up on April 11th when Etsy boosted transaction fee for sellers from 6.5% from 5%. So that's a pretty decent, jump, with a stated goal to fund improvements in marketing, customer service, seller tools. On top of transaction fees, Etsy sellers also have to pay listing fees, payment processing fees, and shipping fees. Obviously, that's just the nature. I mean, it's not that much different from eBay, except there's not an auction. As part of the company's off-site ads program, Etsy sellers are also charged an additional fee between 12 to 15% anytime shoppers make a purchase after clicking on an ad for their product. This is probably, I can understand why that would be concerning for sellers. This, though, is one of the cool reasons that Etsy makes a great stock, is they've basically outsourced their advertising program, outsourced funding for their advertising program. They run the ads that, let's just say you're selling a necklace, they run the ads that sell the necklace. If somebody clicks and buys, you as the seller pays 10 to 15% on that. So it's a great mind map for running advertising, but some of this stuff does add up for sellers. If we take transaction fee, 6.5%, then we throw in the advertising fee, which does not happen on every transaction. Okay, let's get that straight. You have to see an ad, click an ad, buy the product to get charged. But you are starting to get into the 20% as far as just fees. And so the reason that this is important, headline, in my opinion, for the future of Etsy is it is likely going to slow seller growth, not buyer growth, which is essentially way more important. But when you have less sellers or your seller count slows and you take the margins from the sellers, those folks have less opportunity to promote the store on their own, tell their friends that they're on Etsy, things like that. So this is a really good time for Etsy to do this, because second quarter into back to school season is their slowest by far. But we could see this stock hit some sort of bottom over the next 60, 90 days. And then you just have to monitor it and ask yourself, is it the bottom? Do you feel good about it? Because what happens with Etsy is in Q3 and Q4 are their bananas quarters, right? Back to school, generally speaking, fall has a lot of crafty things, right? If you want to talk about Halloween, Thanksgiving, then you get into holiday season, not only from a decorating standpoint, but from a seller standpoint. We talked about jewelry and there's a bazillion other things. So what I'm looking for here in Etsy is I want to see if this news brings it down 6%, I want to see it go down under 100, and then I'll start thinking about it as something that could bounce hard in your favor, particularly starting, let's just call it September, October, as they ramp up for the holidays. So keep it on your watch list. All right, last one, and then we'll just jump into comments. NFL Sunday ticket package may be headed Apple's way. And this is really, really interesting to me. So if you don't know what the Sunday ticket is, it's basically you spend maybe $200 and you can watch any team, any out-of-market team's games. So you turn on your Sunday ticket, and instead of only having 1 or 2 NFL games to watch, which is pretty common, if you like in Cincinnati, they might show the Bengals game on TV and then they'll show another like nationally promoted game, right? So you've got 2 games. And when you have Sunday ticket, which you paid for, you basically get to watch every game except for the Bengals game, because that's being offered for free in your area. So it's a big to-do, and a lot of people, with the popularity of football, fantasy football, gambling, it's a big to-do. And last time, it was previously owned by DirecTV. They were paying an average of $1.5 billion a year to the NFL. Now they're saying, big shock, DirecTV is not what it used to be, so they're just out of the running, period. The estimate is that Apple would pay $2.5 billion on average per year, which is obviously a ton of money. Now, Apple is not hurting for money, but I guess like where my brain goes on this is, what is Apple going to do with it, right? Is it going to be part of the Apple TV Plus or whatever. And so if you're an Apple person, you can just watch, you basically get Plus for free. And in that case, if you're me, who's an Android person, but I also, like my wife and kids all have Apple stuff, so I kind of get the best of both worlds. But how many Android households are going to be excluded from that, or how much will they have to pay? It's really, really interesting. And then, of course, you don't necessarily get it on your big screen TV, depending on, what kind of operating system and stuff you have. So I'm curious to see what Apple's plans are with this. I don't know that it drives necessarily more iPhones. That'd be my guess. I mean, I don't know where it fits in with their product revenue, but it could be a huge play on Apple TV, depending on how things go. Now, the competitor, the other two that may or may not be in it, is Disney, obviously with ESPN, and Amazon. This article notes that they already have some NFL exclusives, which argues favorably for Apple. We'll have to see. I think it fits perfectly on Amazon, because if you ever watch Prime Video, they already sell I almost said sub subscriptions, but they are. They sell secondary subscriptions all over Prime Video. So they sort of have their mediocre content library, which, by the way, gets a lot better if the MGM thing ever goes through. And then across the board, you can sign up for Showtime, HBO, all those things right from your Amazon account and cancel right from your Amazon account. So I could see it fitting very well in Amazon. Apple, I'm a little stumped, though, how it fits into the plan, but we'll see how it goes. All right, take a quick look at the markets here, and then we'll jump in to some comments. So you can see it right at the top here, not very big, but Dow Jones minus 0.2%, S&P and NASDAQ right in the same neighborhood. Not a lot of movement out of the other things either. Gold plus 0.35, oil at 107, Bitcoin bumps back above 40. That was below 40K the last I looked at it. All right, let me grab a drink here of water. And let's see what we got. So 21 says, Derek, good idea. Did that already. Okay, yeah, you guys are still talking Intel. A lot of insiders bought Intel stock. That's interesting. We can try to look at that in a second. Ali says Intel has 3% dividend compared to AMD, and payout ratio is 28%. Yeah. So a lot of Intel support in the chats right now, which is interesting. I'm not against. I think Gelsinger is a fun CEO, and I love anytime a guy were to leave a team, company, whatever, and come back when it gets beaten down to make him better. It's a phenomenal story, and he seems like a great guy. I just think it takes a long time to build foundries and ramp this stuff up, but I wouldn't say Intel is a sell or a void or anything like that. I would just say that, in my opinion, it's just going to take a little while longer to get pure momentum, talking about breaking ground on this and chips releases here and all the things that you really need. The AMD playbook from the pandemic, those are all things that you need. And right now, I don't think Intel can do that fast enough. But starting in 2023, like Jan 1-ish, start to see some of those headlines to trickle in. They are up today 2%, which is a good sign. And yeah, you cannot argue their valuation at all. Zero concerns there. Derek's still holding everywhere. He spent all his cash, but got about 10% on the sideline. Yeah, we're very similar right now, Derek. I do, let's let's see, what would be my percentage is probably 10 to 15% in cash, but it also, that last bit of cash is one that I am more stringent with, okay, because it also serves as a nice backbone as a person who has kids and a house and whatever. It's a nice little safety net just in general to have laying around. So I have no problems buying into it if stuff looks like incredibly awesome, but I'm basically playing with my last grand in the stock account right now, as far as like easy money that I would throw at the market no matter what. And I've seen weakness, but I haven't seen like just the utter meltdown that would make me jump in. So we'll see how long my $1,000 lasts. And we'll just, go from there. I think it's just a weird time. And I said it on, and that's the other thing we got to look at too. I said this last week or the week before. I don't know, man. I feel like you're playing with fire pre-earnings with a lot of the companies that I follow, which is very heavy into NASDAQ stocks and consumer discretionary. Okay, those are just my favorites, and that's how I do things. All of those names, I would say, have that 50-50 earnings call, right? Like I think travel looks like it's got to be back, certainly domestic travel. But outside of that, we talked about chips. If you look at FANG across the board, there's an argument against all of them, except for maybe Google. I don't know why no one wants to buy that. And then banks I'm not super interested in. I would rather buy something that's a little bit more dilapidated and hope it bounces back. But here's what we got this week. So we had Bank of America. Actually, let's just skip ahead to tomorrow. Johnson & Johnson, Fifth Third, Lockheed Martin should be interesting to see if they've gotten any new contracts out of the situation over in Russia. Manpower is one that's very interesting to read their reports because they provide temporary labor, mostly for the industrials. So if you want to get a feel for how many people are returning back to work, Manpower could be very interesting. In fact, I'd like to just take a second and see where I haven't looked at their stock in a while. See how the past year has been. All right, so this is interesting to me. And again, I have not read up on this company in a long time, but they're down year to date, much like the rest of the market. And it's got to be, let's see how they define themselves. Manpower Group provides workforce solutions, internationally. Company offers recruitment services, permanent, temporary, and contract recruitment. So when you're in a jam for workers, and let's take this on like the corporate level, okay? So let's just say it's, Derek, let's just say it's tax time and you need 7 staff accountants to keep up with demand, okay? This is a kind of company that you would call. You don't necessarily want to hire 7 staff accountants and pay for the full rigmarole on benefits and whatnot. So you would call a company like Manpower and you would have a contract. Maybe it's a 90-day contract, 120, something like that contract. And, the top performers, you'll probably extend them, try to bring them on, something like that. Whereas most of the average Joes, you're just going to kick them to the curb. Tax season's over, you go along with your business. Well, not only does this happen in accountants and tax offices, it can happen in legal, can happen in restaurant management, okay? It can happen in construction, labor, actual labor force. With construction, particularly corporate construction, they're going to use this stuff all the time for general laborers. All right, so when you think about, obviously electricians, plumbers, they have a special license, but if you're, I don't know how much you guys know about construction sites, but at the bottom of the chain, there's general laborers, right? Those guys, they actually make decent money. They're probably making 25, 30 bucks an hour, if not more right now. And they're basically hauling shit from one side of the room to the other, okay? And they're putting stuff in a wheelbarrow. They're getting the roof shingles up to the roof. It's not a glamorous job, but you can make money, and it is an important part of the construction operation. Manpower would be somewhere you would go and say, hey, we're building 4 homes on a cul-de-sac, and my laborers are all gone, or they quit, or whatever, they got arrested. I got 90, 120 days if you got laborers, and I'll pay Manpower will charge them 50 bucks an hour. They'll pay the laborer 35, whatever, and then they'll keep 10. So if that was a ramble, but hopefully y'all understand how it makes sense right now. People need workers, and Manpower's job is to provide them, and they're incentivized to do so because they charge 1.5 to 2x the hourly rate that a normal company would pay. So what I'm saying here is when their earnings come out, see what this earnings preview is. Consensus estimate is $1.59 versus $1.11 the prior year. Revenue estimate up 3.3%. Over the last 2 years, they've beaten EPS estimates 88% of the time. Over the last 3 months, EPS estimates have seen 5 upward revisions and 2 downward. Revenue estimates 0 upward revisions and 6 downward. So I would have never guessed that. And that's why you have to read more about a stock. But I will say that if you have any interest in anything I just talked about in the labor and temp market that is out there, read their earnings, at least download their earnings presentation and look through it. It's a crazy industry, man. Crazy industry. And companies pay a lot of money to secure workers, because you can't go every day running a McDonald's with 1 or 2 people. And if you can't attract somebody to fill an application out and bring them on, you go to companies like Manpower, you say, I'll take 5 people tomorrow if possible. And, you probably get it if they're doing their job. All right. Synchrony Financial could be interesting. They actually issue credit. So hopefully they're not sinking underwater. We're still on 418. So 419, there was Manpower. What else we got here? A lot of banks, we knew that. Netflix tomorrow. We talked a lot about Netflix. IBM tomorrow. So I don't know if Lions came in at all yet, but he's a big IBM guy. Halliburton gets back to some mining industries. And what are we on? We're still on 419. I'm going fast, looking for names that stick out. Anthem, huge health insurance holder, Anthem. The NASDAQ, which is not really as exciting as it sounds, to be honest with you. We got some railways, CSX. So railways are, guys who follow industrials are always interested in the railways because it just talks a little bit to the effect of demand versus supply, and obviously shipping expenses are at the top of everyone's mind. So I have a feeling that CSX and there's others here, they will probably have very important calls, and they will probably say that they are increasing their shipping rates. That's my guess. United Airlines, Delta crushed it last week, I believe. Will United carry through? And if they do, you can just throw it on the board that summer travel season domestically is going to crush it. So for the guy who bought Disney, Michael T., it's good news. Now, the street is going to screw up Disney somewhere because there won't be enough Disney Plus subscriptions, but, whatever. If the parks start making money and that's where the profit is, built the entire company, then I would say summer travel being good is good news for Disney. And if you did get it at 125, Let me just see something real quick. Oops. Disney. 127. Yeah. I haven't done this. I haven't looked at their earnings estimates for a while. But if the parks are going to go up, you can assume that they're going to be cranking the dollars. And the best part about Disney that's going to go unnoticed by most people is that fiscal year ends in September. So if you're in the mode to hold for a full 12 months, you are going to inherit the holiday season of 2023 on the next EPS estimate, which is a plus 26%. So it's an interesting way to play an odd fiscal calendar. So keep that in mind. All right. Tesla. So Tesla 420, that is 2 days from now. That will obviously be interesting. Everybody, including myself, is always shocked at what they get done. And I assume I will continue to be shocked. Carvana, to me, I'll read that one. I'll at least read the press release there because I want to see how the used car market is going. There's rumors that prices are coming down. Lam Research is a chip provider, so that will draw plenty of attention. Aluminum, not going to get into that. AT&T, 421. You know what? Who cares about Xerox? NextEra Energy, there's a lot of folks who play renewables. NextEra is probably the largest corporate renewables energy provider, off the top of my head anyway. There's Union Pacific, another railroad. And I'll stop there. So definitely Netflix, definitely Tesla. Airlines, I think airlines should be a good precursor to everything else. Travel and Freeport, McMoran, that could be interesting on the lithium side because there's a lot of rumors about lithium shortcomings. And I'm going to stop there. So it's a fun week. I would say next week and into the first week of May, or it gets even more fun. But there's a lot of stuff brewing. A lot of stuff brewing out here. All right. So Derek's got more than emergency funds. I mean, mine's like quasi-emergency. I have the do not touch ever savings account that's not it's not a huge amount of money, but it's 3 or 4 mortgage payments in there, and that one just sits idly. And then the one that's 10 or 15 grand that I can get into, that's one that I do auto deposits into. That's why I don't know how much it is right now. And I keep it, if it's an epic crash, we'll start taking some and putting in. But it would be very unlikely that I took all 10 or 15K from that one and piled it in because I still like to have the big number. And unless it's just so Captain Obvious. And Derek wants to see SPY at 400. I answered a comment today that was just my opinion. Did you think the SPY would get to 415? And the way I responded to it was, if I had to bet, I would say it could certainly go down again. I mean, that's the stock market. I would guess it would go to a higher low. So if the low was 416-ish is what it looks like, I would say the next low is going to be in the 420 range. Wish I could tell you what the magic formula was for that pick, but I would just say I'm kind of sticking with we saw the absolute bottom, and I don't say that in the sense that I think it's a rocket ship up from here. I expect to see continued volatility, but will it go to 416 again? Will it close at 416 or below? I'm going to go ahead and say no. That's my bet. And I understand that other people have different perspectives, and that's fine. It's just me picking a name out. Vicky switched to option trading, mostly short everything. Wow. Well, you've certainly done well in that trade this year. Shorts, that's crazy. There's Lion. Markets need the Lord and Savior. Hopefully Canada's getting better. Lion, I haven't seen any updates on the truck strike or, the crazy COVID lockdowns, but hopefully you're doing better. SC's here, also an amazing time to buy TQQQ. That is true. Where are we at today? So I went up as high as 20% on my TQQQ this year, and now we are officially below my cost basis. So that might be one because it's so cheap that I add some shares, but I'm not super excited until we get into full-scale earnings. Because if you look at year-to-date, I averaged into the $47 range, and then it got as high as, 62. So I went up nicely, and it's melted down since then, which is fine. I wasn't expecting to just, turn it around quickly, but it's one I watch, and now it's below my cost basis again. So worst case scenario for me, I would be inclined, if it got below, say, 45, I would be inclined to continue lowering my cost basis. Oh, Derek says big dip here at the end of the market. Yeah, about 0.5% out of Dow, SPY, and NASDAQ. It'll be interesting. Tomorrow will be, more earnings and Netflix tomorrow, which just having Netflix tomorrow will bring upon the speculation of everybody else. So we'll have to see how it goes. But anyway, guys, hope you enjoyed my hand-picked news headlines there. Hopefully you found a couple that were interesting for you as well. I'm going to head out for the day, but thanks everybody for coming, and we'll see you on the next video.